At the final GAC conference Ed spoke at, he announced that in February of 1985 that we were leaving to form Callahan and Associates. Ed still had two and a half years left on his term of office, and the credit union system wanted to know why. Why are you leaving? And he had two answers, both of which I think are correct. The first, he said, I want to leave before we screw it up. And if you've seen people who stayed beyond their course of time, that sometimes happens. But I think the more positive reason was that Ed said, we want to help credit unions in Callahan and Associates take advantage of the opportunities that have been opened up by deregulation. And so the three of us went to Callahan and Associates, which opened up on May 1st, 1985. One of the first things we did there was to use the discipline and practice that we exercised both in Illinois and at NCUA to establish the first complete database of all credit unions in the country. Now, that might sound like a simple exercise in this automated, all-encompassing call report era we're in today. But in 1985, there were still a half a dozen or more private share insurers. The states were very reluctant to share that information with any outside party, let alone NCUA. And so there was no central point at which all this data could be assembled, analyzed, both in macro and micro terms and so on. So Ed, Bucky, and I said, we're going to make this our calling card, data, looking at data and so on. And so the first thing that we produced as a product or service was the credit union directory. And the credit union directory was the first effort by anybody to record every credit union and list their name, phone number, and financial statistics and address to see what the totals were, not only nationally, but by state and so on. And this took time. We had the cooperation of cooperative insurers, which sent their data to us. We got the data from NCUA and then literally had to create a new database that would merge the two together. And the result was the first credit union directory. This is a later edition in 2006. But it became a milestone and it was significant. It was significant because there were 3 or 4 things I think the directory symbolized, besides the fact that this was the first time that there had been a complete census of every credit union in the country, insured, uninsured, NCUA insured. It was the first time there had been a complete listing. There had been macro numbers. CUNA had been publishing their best estimates of numbers, but no one had the complete data at their fingertips. And I think it symbolized that the cooperative system was now coming together. It was now complete. These 3 prior eras before deregulation, the founding of the individual credit union, the National Credit Union Act, and then the expansion of trade groups, cooperative insurers, CUSOs, all those ancillary corporations that are so critical to making a system, not just an aggregation of individual credit unions, had come together. And this directory, I think, both symbolized and recorded that fact by showing all of the elements in later editions of the credit union system, who the state leagues were. There was a time when they listed all the CUSOs in the country, so that this was becoming a reference point for a system that was now recognized as being a very important choice, a very important role in America's financial service industry. I think the directory symbolized the coming of age, if you would, the recognition that the credit union system was really an alternative for consumers in America. And I think this is symbolized by something that happened in 2010 or 2011. It was a national effort started by a consumer, an individual, called Bank Transfer Day. And it was a reaction of the public to what they felt had been abuses of the banking industry that had contributed, if not led to, the financial crisis of 2008 and 2009. And I think in that sense, the directory continues even to this day to show that credit unions are a system. You can look at them as an integrated group. And where Callahan's took this was to automate the data that went into it and create the first software database program available to analyze credit union systems, not only individually, but collectively. And that software was named Peer-to-Peer. And it continues to be a leading resource for individual credit unions or for those individuals that want to track the industry in a macro sense. So that's the end of the second part.
I can tell you that from, as you're talking about this directory, I'm old school enough to remember the old alumni directories that you used to get every year from your schools, and it sort of mirrors that in my mind, that you wait every year to get this directory, and you thumb through and you find yourself, and then you check all of your friends. And I think that it certainly speaks to the cooperative movement and the fact that we all can come together and share this information and for the greater good of credit unions across the country.
It was also an example, everybody counts. There have been efforts to try to publish directories before this. NCUA published a directory and continued to do, but it was just federal charters only. They did not even include state charters. They did begin to include them once they became federally insured. There had been a directory put out by one of the credit union publishing firms called the Top 4,000. So, and then there had been individual state directories put out by the credit union leagues by and large, but those were private. Those were for use only by members. It wasn't information that the general public could access. So in some ways, the Callahan Credit Union Directory represented this opening up of the credit union system to the outside world. Stephanie, this sign that I'm holding up is a very important part of credit union history. This is what the Illinois Credit Union League gave to Ed Callahan when he left to become chairman of NCUA. And it expressed their interpretation of Ed's philosophy, saying, we don't run credit unions. And that was what he tried as his benchmark, because he actually put that sign and hung it in the chairman's office at NCUA for everyone to see. So I want to fast forward now. Where are we? Because in that diagram of the credit union history that I showed you earlier, I show this era of deregulation, this era of credit union expansion and success, kind of coming to an end in 2008, 2009, the time of the financial crisis. And that would be the 100-year mark. The first credit union was 1909, 2009. And this era has yet to be named. We're only halfway through a 25-year generation. And I think the reason I put up that sign of deregulation is because I would tend to characterize this initial 10 years post-crisis as one of regulatory backlash. And by that I mean, when you looked at what happened in the initial years of the crisis, this idea that credit unions had raised sufficient structures to be self-sufficient, self-help, self-funded, no matter the circumstances, was compromised with NCUA's management of the corporate legacy asset crisis. Everyone in 2008 and 9 was very concerned about the individual investments that were backed by real estate. The corporate credit union system had invested in long-term assets that were all legal to do at the time. And these assets had declined in value, not just because of the crisis, but also something that was called market dislocation. That meant that the cash flows were so uncertain that instead of modeling the cash flows and pricing that accordingly, there was a X factor that was built in to reduce the value of those assets. There was an accounting practice at that time. It wasn't new, but it was applied to this new incident called OTTI, other than temporary impairment. And the NCUA interpreted that and used external consultants to force corporate credit unions to write down these legacy assets using models and forecasts of the potential cash flows of interest and principal payments out for the entire life of the legacy assets, sometimes going out as far as 20 years. No model, no human being is capable of forecasting the future out 20 years, but that's what was done. As a result, NCUA said, we're going to liquidate 5 of the largest credit unions, and they produced numbers that have subsequently proved to be tremendously wrong. In their initial publication, they said the cost to resolve these 5 credit unions would be $13.5 to $16.1 billion, including the $5.6 billion that have been written off of the capital of the credit unions. Today, we know for sure that those legacy assets that were supposed to be so severely impaired have produced a surplus of over $6 billion. It was a reaction that was both uninformed and catastrophic. But what has continued has been a reassertion of regulatory authority and regulatory autonomy. NCUA has, at its leadership levels, have prided themselves on their independence from the credit union system. And it's been kind of coupled by an effort to ignore, sometimes disparage, but certainly not work mutually with credit unions when issues come up. And I think one of the ways to capture this mindset, this cultural, I would almost call it return, is to look at 1 or 2 of the proposals that came in the aftermath of this. The corporate systems problems have been well documented, but the agency then went ahead to propose rules that would have required their image and their view of what credit unions should be to be a matter of regulation, not market determination or not credit union determination, leadership determined. One rule was passed in December 2013, a proposed rule by 2-to-1 that would have done away with credit unions that work from home. And the regulation's goal was stated, and I'll just read because I think this is important. The regulation was proposed as a rule to intend to ensure all federal credit unions operate in a manner consistent with modern day expectations for insured financial institutions. That is, if you're not operating the way we think you should operate, then we're not going to allow you to have a charter. Now, not only was the rule based on misleading and inaccurate facts, but it reflected a view that the regulator knows best. The regulator not only knows best about its own responsibilities, but what credit unions should be doing. And there was a credit union who felt very strongly on this and wrote a comment that I think captures why this is the antithesis of what deregulation was intended to be, both in spirit and in fact. And when he was commenting on this vague modern day criteria, he said that that will effectively kill all new charter, credit union charter activity. And he said, it's not about the fact that I believe 500 credit unions will pop up tomorrow. It's about the fact I support their right to start, exist, and maintain a credit union charter. It's about the fact that I do not believe that NCUA gets to make the call on what is relevant. It is here to serve American consumers and their right to form and maintain a financial cooperative. When a regulatory body decides it makes the call on whether a charter is relevant, then the spirit of renewal is dead, then the spirit of pioneers is dead. Also dead is the hope that, should we need more credit unions in the future, there will be a fair process or will to foster them. And that's what I mean by regulatory backlash. There have been very, very few new charters. In fact, one of the new charters, Maine Harvest Credit Union, was actually begun in 2011 and did not get their charter until 2019, did not make their first loan until 2020. that chartering process would discourage all but the most ardent believers. And in fact, there have been very, very few new charters. There was also an effort to actively encourage, beyond the examiner's encouragement, credit unions, and particularly smaller ones, to merge. And this was done in a publication called Truth in Mergers. It was put out by the Office of Small Credit Union Initiatives. And the truth of that brochure, when you look at it, is that we're going to ask all small credit unions to merge. Either you do it voluntarily, or we will do it forcibly. It's very clear what their belief in credit unions is. And so this mindset, this fact that they had the authority to deal a very crushing blow to the corporate system that was not, in fact, justified by events or by mature judgment, has continued to set the agency apart. And so I think what we're facing today in the credit union system is a challenge. It's a challenge that Ed Callahan described many years ago in one of his comments, that said that the impulse at both the regulatory level and sometimes even with credit unions to want to be bank-like in their activities is the greatest threat to the cooperative charter. And as you look at the 7 cooperative principles, I think you'll see that they're still valid. Cooperative design is a tremendous, tremendous asset where the customer and the owner are the same person. But you'll see this tension that the cooperative system has between the pull of the marketplace and the protection afforded through the tax exemption on the cooperative design is constantly before us. And it shows up in a number of current issues. Credit unions are buying banks. Now that seems kind of contradictory. Why do we have credit unions if their goal is to go out and buy banks? Another example would be the almost idolization of size. It's called the myth of scale. There's been a lot of data done, but you will find consultants and many credit union managers that believe that the only way to survive is to get bigger and bigger and bigger. And in fact, the data that's available, in fact, data published by the FDIC, really belies this point. So I think if we lose that sense of purpose, that sense of who we are and our uniqueness, we run the risk of slowly becoming irrelevant in the consumer's view of what makes a credit union different. They're just like all other financial institutions. And so that's my worry going forward, because the history of credit unions and even the performance today, if you look at the year-end data of credit unions, is just exceptional. They are providing major, major benefits, not only in times of good times, but in times of crisis, to help members in ways that other institutions, particularly for-profit ones, either are not empowered to do in the same way, or if you look to government for solutions, it takes time, it's uncertain, and the government is a very crude response to the very specific needs that many credit unions and communities have. So that's where we are. We've gone from deregulation, building out a system of institutions that supports a cooperative network, to where today we still face the same challenge. Do we become more and more capitalistic, or do we become more and more purpose-driven? And that's a challenge that's been with us from the beginning.
Absolutely. I can speak to a exhibit that we have at the museum that gives one of Ed Filene's famous quotes, is that the challenge is to become big without becoming biggity. So I think that certainly if he was saying that 100 years ago, it is still true today. So thank you for sharing this little bit of credit union history with us today, Chip. This has been very informative, and we can only learn from where we have been. That is certainly the mission of the museum, to share those stories of the past so that we can be inspired going forward.
And Stephanie, I really must congratulate you and the museum on the role it's doing to become the central archive point for this cooperative history. If we forget our history, if we forget where we've come from, we really lose perspective on where we're able to go. We get caught up in present controversies and we don't see the legacy that we've inherited. So congratulations on your becoming a repository for all of the good works, and I hope that you can get leaders to continue to augment your resources and turn those out into everyday learnings for us and the people who are coming into the movement, maybe without the lengthy perspective that some of us have enjoyed.
Absolutely. Well, thank you again, Chip, for being part of this series. This is another moment in credit union history brought to you by CUNY Mutual.